This isn't a bank heist, it's a grocery run. The money in this wheelbarrow has a shelf life, and it's expiring faster than the bread he's trying to buy. Germany stood in the shadow of the Great War. A proud industrial empire had been brought to its knees. Military defeat was only the beginning. The peace that followed was a crushing weight. The Treaty of Versailles demanded reparations on an impossible scale. This was a debt to be paid by a nation whose economy already lay in ruins. The question facing the new Weimar Republic was existential. How do you pay an unpayable bill? The answer had begun quietly, almost a decade earlier. On July 31st, 1914, as Europe tipped into war, Germany's central bank, the Reichsbank, made a fateful decision. It suspended the conversion of its banknotes into gold. 4 days later, this act was enshrined in law. Another law authorized the bank to start treating government debt, simple IOUs from the Treasury, as if it were as good as gold, using it to back new banknotes. The government's reasoning was simple. Wars are expensive. Raising taxes on a population already sacrificing for the war effort is slow and deeply unpopular. Instead, they would borrow the money into existence. This strategy, however, depended entirely on one critical assumption, a single point of failure embedded deep within their plan. They believed with total certainty that the defeated enemy would be forced to pay every last mark back. It was a gamble on absolute victory, but Germany lost. And the bill for that gamble was about to come due, affecting not just the government, but every single person who had ever trusted the value of the money in their pocket. What followed was the complete disintegration of the financial basis of a society. It was a time when all the rules of money were inverted, where savers were punished and debtors were rewarded, where a lifetime of prudence could be wiped out in a week, and a fortune could be built on the art of spending borrowed money before it turned to dust. This is the story of how money itself died. For the first few years of the war, the decay was subtle. The Reichsbank, led by its president Rudolf von Havenstein, adhered to a convenient fiction. So long as its paper notes were backed by treasury bills, which were in turn backed by the full faith of the German state, there was no inflation to speak of. It was a circular argument that ignored the growing ocean of paper. The government financed its immense expenditures not through taxation, but through this seemingly endless line of credit from its own central bank. Periodically, it would attempt to fund this floating debt by issuing long-term war loans, calling upon the patriotic duty of its citizens. The German people responded, subscribing to nearly 98 billion marks in war loans over the course of the conflict. It was never enough. By the autumn of 1916, the system was failing. The amount of new debt being printed far outstripped what the public could absorb in loans, yet the printing continued. By the armistice in 1918, the amount of currency in circulation had increased more than fourfold since 1913, and the government's floating debt stood at 55 billion marks. Still, the system did not collapse. A powerful psychological inertia was at play. There was a shared belief that this was a temporary state of emergency. Many people, especially in the countryside, hoarded the paper notes, believing they would regain their full value once the war was won. This act of saving, of taking money out of circulation, acted as a temporary brake on the price increases. The official statistics of the era tell a story of a system under strain, but not yet broken. In October 1918, wholesale prices were 2.3 times their 1913 level, while the currency in circulation was 4.4 times higher. An odd divergence was taking shape. The money in a German's pocket was beginning to be worth more at home than it was abroad. The external value of the mark had only fallen by about a third. It was a sign of a deep imbalance, a secret the international markets knew before the German people did. Then came the armistice. The national project was over, and the bill, now impossibly large, was presented not to a defeated enemy, but to the German people themselves. The new Weimar Republic inherited a financial nightmare. The cost of demobilizing an army, the burden of unemployment benefits for millions of returning soldiers, the urgent need to import food for a starving population, and the heavy payments demanded by the Allies created expenses that dwarfed the state's meager income. The political will for a bold new tax plan was absent. The fear of triggering a Bolshevik-style revolution was paramount. Faced with an impossible choice, the new government chose the path of least resistance. They kept the printing presses running. In the last 2 months of 1918 alone, the money supply increased by another 24%. The summer of 1919 brought the psychological turning point. With the signing of the Treaty of Versailles, the sheer astronomical scale of the reparations bill became public knowledge. A wave of profound pessimism swept through the country. For the first time, a phenomenon appeared that would define the era: the Flucht aus der Mark, the flight from the mark. Faith in the currency shattered. Anyone with means, industrialists, merchants, the wealthy middle class, rushed to sell their marks. They bought US dollars, they acquired Swiss francs. They sought anything that felt safer than the money of their own defeated nation. This triggered a dramatic collapse in the mark's external value. While prices at home continued their steady climb, the price of a dollar on the exchange market exploded. The divergence that had begun during the war became a chasm. In October 1918, a gold mark was worth 1.57 paper marks. By December 1919, it was 10.8. By February 1920, it hit 23.6. This gap between the internal and external value of the mark created a strange, feverish economic reality. For foreigners, Germany became the world's biggest bargain bin. A traveler could exchange a few dollars for a mountain of marks and live like a king. They bought up property, art, jewelry, and industrial goods for a fraction of their global market price. A report from the Deutsche Bank described Germany in those months as a great fair for purchasers from every country. This created an export premium, a powerful artificial stimulus for German industry. Factories that had been dormant since the war roared back to life to meet the insatiable foreign demand. Unemployment, which had been dangerously high, began to fall steadily. From the outside, it looked like a recovery, but it was a prosperity built on a national clearance sale, a boom financed by selling the nation's wealth at a deep discount. The government, seeing the fall in unemployment, felt it had no choice but to continue. The new fiscal reforms, proposed by Matthias Erzberger in 1920, designed to create a modern system of national taxation, were too little, too late. The deficits continued to mount, and every deficit was paid for by the Reichsbank's printing press. Even in a period of relative stability for the mark's exchange rate, from early 1920 to mid-1921, the floating debt doubled, and the amount of money in circulation grew by another 20 billion marks. The fuel for the next stage of the fire was being quietly stacked. The kindling caught light in May 1921. The London ultimatum was delivered, a schedule of payments that formalized the immense reparations debt. Germany was now required to pay 2 billion gold marks annually, plus 26% of the value of its exports. To make the first payment of 1 billion gold marks by the end of August, the government went to the foreign exchange market and bought dollars, pounds, and francs. It paid for them with newly printed paper marks. The flight from the mark turned into a stampede. The price of a dollar, which was around 76 marks in July, skyrocketed to over 241 by October. This was the beginning of the vicious circle. The need to pay reparations forced the government to print marks to buy foreign currency. This printing devalued the mark, which made the next payment even more expensive, requiring even more printing, which devalued the mark further. And at this moment, a new class of economic actor rose to prominence. While the nation's wealth evaporated, a small group of industrialists and financiers, men like Hugo Stinnes, were building empires. They had discovered a way to weaponize the inflation itself, turning the government's printing presses into their own private engine of wealth. So what was their secret? It was a strategy of brutal simplicity. Borrow colossal sums of money from the banks and paper marks. With those borrowed marks, buy up anything with real, tangible value: factories, coal mines, ships, newspapers, forests, then simply wait. As the inflation raged, the real value of the loan would evaporate. A debt that might have been worth a factory when it was taken out could be paid back a few months later for the price of a single machine inside it. This process fueled a wave of industrial concentration unlike any seen before. Stinnes, who started the war as a wealthy coal merchant, became the master of a vertical empire that controlled every stage of production. For these men, debt was a weapon, not a liability. The banks, under the obliging leadership of the Reichsbank, kept interest rates far below the rate of currency depreciation, effectively paying the great industrialists to take their money. Inflation was the business model the general public began to catch on. The belief that the mark would one day recover died. The instinct to save was replaced by the instinct to spend. This was the birth of the flight to Sachwerte, or real assets. Why keep money in a bank account when it would be worth 20% less next month? It was better to buy another pair of shoes, a new piano, anything at all. The money had to be kept moving. This increasing speed of transactions is what economists call the velocity of money, and it was beginning to accelerate dramatically. As more people tried to spend their money faster, the upward pressure on prices intensified, independent of the actual amount of money being printed. The national economy was now splitting in two. On one side was the world of paper, the savers, the pensioners, the bondholders, the salaried employees, anyone whose income or wealth was denominated in marks. They were being systematically impoverished. On the other side was the world of real assets. The industrialists, the landowners with mortgages, the speculators, and anyone with the foresight to get out of cash and into things. They were reaping unimaginable rewards. The government saw what was happening but felt powerless. Any attempt to stop the inflation, they argued, would mean an end to the artificial export boom and a spike in unemployment, risking social collapse. For them and for the industrialists, who profited from the chaos, inflation, as devastating as it was, had become a necessary evil, a way to keep the factories running and the workers paid. By the summer of 1922, the situation was spiraling out of control. The mark's value was in free fall, and the social fabric of the country was beginning to fray. The bottom was not yet in sight. The final descent began in January 1923. Citing Germany's failure to meet its coal delivery quotas, French and Belgian troops marched into the Ruhr Valley, the industrial heartland of the nation. The German government, led by Chancellor Kuno, called for a campaign of passive resistance. Workers were to lay down their tools, officials were to ignore the occupiers' orders, and the government promised to pay their wages for the duration. It was a patriotic gesture of defiance, and it was financed by turning the printing presses to their absolute maximum speed. What had been a spiral now became a vertical plunge into the abyss. The last vestiges of confidence in the paper mark evaporated, not just month by month, but day by day, hour by hour. The velocity of money became almost infinite. A worker paid in the morning would rush to the market, knowing that if he waited until the afternoon, his wages might only be worth half as much. Shopkeepers changed their prices multiple times a day. The situation devolved into a strange and terrifying paradox. The Reichsbank was printing trillions of marks a day, yet businesses, city governments, and families were all complaining of the same thing: a desperate shortage of money. How could a country be drowning in cash and simultaneously running out of it? The answer lies in the difference between the number on a banknote and what it can actually buy. The real value of all the money in circulation was collapsing faster than new bills could be printed. Society began to break down. The social contract, built on the shared trust in a medium of exchange, was null and void. Farmers refused to sell their crops for worthless paper, leading to severe food shortages in the cities. The middle class, the bedrock of the nation, was utterly destroyed. A lifetime of savings invested in government bonds, a pension meticulously planned for decades, was now insufficient to buy a postage stamp. People sold their wedding rings, their furniture, their family heirlooms for food. Crime rates for theft and misappropriation soared as desperation took hold. The mark was no longer functioning as money. In its place, a chaotic ecosystem of alternative currencies sprang up. Foreign currencies like dollars and Swiss francs became the medium for any large transaction. Companies in town started issuing their own emergency money, the Notgeld, some with an expiry date, others supposedly backed by bushels of rye or kilowatts of electricity. By the autumn of 1923, there were over 2,000 different kinds of these currencies circulating, a return to a medieval patchwork of private monies. This was the peak of the madness. On a single day in October, the Reichsbank issued 120 quadrillion paper marks, and it wasn't enough. The demand for that day was nearly 10 times higher. Prices had become astronomical, meaningless numbers. A kilogram of bread cost 428 billion marks, a newspaper 200 billion. A single tram ticket cost 150 billion. A practice emerged where prices were set based not on the current exchange rate, but on the expected exchange rate for the next day, a self-fulfilling prophecy of collapse. The monetary system had reached its logical, insane conclusion. Germany was a modern industrial economy without a functioning currency. The social order was hours away from complete dissolution. In the darkest hour of the collapse, the government of Chancellor Kuno fell, and a new coalition led by Gustav Stresemann took power. His government understood that the choice was no longer between inflation and stability, but between stability and utter disintegration. On October 15, 1923, a decree was passed to create a new bank, the Rentenbank, and a new currency, the Rentenmark. The plan was a work of psychological genius, born of desperation. The new currency had no gold backing. The country's reserves were nearly gone. Instead, it was to be backed by a mortgage on the entire productive capacity of the nation, all its agricultural land, and all its industrial property. It was a fiction, a theoretical claim on real assets, but in a country that had seen the fiction of paper money exposed, a new fiction backed by the solidity of land and factories was a powerful idea. The true turning point came on November 15, 1923. On that day, the Reichsbank was ordered to stop discounting government treasury bills. The printing press that had financed the government's deficits for nearly a decade was, by law, shut down. 5 days later, on November 20th, the currency commissioner, Hjalmar Schacht, took the final audacious step. He pegged the old, worthless paper mark to the US dollar at a rate of 4.2 trillion to 1. And then the miracle happened. The chaos stopped. The new Rentenmark was introduced in exchange for the old paper marks at a rate of 1 to 1 trillion. The crucial detail was the strict limitation on its quantity. The government could only borrow a fixed final amount of the new currency, after which it would have to live on its own tax revenue. The German people, exhausted by the chaos and desperate for any anchor in the storm, accepted the new money. They had faith in it, not because of its bizarre mortgage backing, but because they had faith in the government's promise to never print uncontrollably again, and because everyone believed it had value. Confidence returned almost overnight. The frantic velocity of money ceased. People began to hold currency again instead of spending it instantly. Farmers began selling their produce for the new stable money, and food flowed back into the cities. The foreign exchange rate held firm. As the nightmare was over, the cure was not without pain. The end of inflation triggered a severe stabilization crisis. Businesses that had only ever existed by exploiting the arbitrage of inflation, the so-called children of the depreciation, went bankrupt in droves. The process of rationalization, long postponed by the artificial boom, now began in earnest. Factories were closed, production was consolidated, and unemployment, which had been artificially low, spiked dramatically, reaching into the millions by 1926. The hyperinflation carved a permanent scar on the German national psyche. It accomplished a social revolution far more profound than the political one of 1918. It wiped out the savings and the social standing of the old middle class, the pensioners, the academics, and the small capitalists, leaving them impoverished and resentful. It created a new plutocracy of speculators and industrialists who had mastered the rules of the inflationary chaos. This event left Germany with a deep and abiding fear of inflation and inflation's angst that influences its economic policy to this day. But its most devastating legacy was political. The destruction of the moderate middle class hollowed out the social foundation of the fragile Weimar Republic. It eroded faith in democratic institutions and left a population traumatized, disoriented, and susceptible to the promises of extremist movements that offered simple explanations and radical solutions. When the Great Depression arrived less than a decade later, the memory of 1923 was paralyzing. German governments pursued brutal policies of deflation. They cut spending and wages, terrified of restarting the printing presses. These policies deepened the new crisis and drove unemployment to catastrophic levels. The economic chaos of hyperinflation had done more than destroy a currency. It destroyed a social order. It cultivated a deep-seated resentment and a longing for stability at any cost. As the historian Lionel Robbins would later write, the political disasters that followed were not an accident. Hitler was the foster child of the inflation.